Welcome to Kopi Time, a podcast series on markets and economies from Devious Group Research. I'm Timur Beg, Chief Economist, welcoming you to our 169th episode. Happy New Year to the listeners and viewers of this podcast series. We appreciate your participation very, very much. Well, what a start to the year. You'd think that 2025 was eventful, from the tariff and trade-related seismic announcements that Donald Trump made in the first quarter, and that led to a tremendous amount of consternation in the second quarter. We had a lot of back and forth around trade and tariff. We had massive conflicts between Israel and Iran. There were attempts at bringing a deal on Russia-Ukraine. Hasn't really gone anywhere, but 2025 was eventful to say the least. But given the first few weeks of January 2026, this could well be a year when things are even more eventful. Just consider what has happened with respect to the U.S. in the first few weeks of this year. We had the overtures already. You could tell that the heat with respect to Venezuela was going up a lot through the buildup of U.S. Navy presence through the summer of last year. And then, of course, the strikes on ostensibly drug-carrying boats around the Caribbean repeatedly. But then we began the year with a spectacular abduction, removal of President Maduro, who's now in New York facing trial. And then not a whole lot more in Venezuela, although Donald Trump has been very clear from his perspective, it's about the oil. He wants U.S. oil companies to get a big piece of the action of extraction and refining of Venezuelan oil. How that pans out remains to be seen. It's not that easy to turn around an ailing oil industry like Venezuela's in a short time period. But nonetheless, the idea of getting somebody who will play ball with the U.S., I think has become a little more real as opposed to the case with President Maduro. And that's just one of many external developments. You could tell that the developments out of Venezuela have emboldened Donald Trump substantially. He's talking quite extensively about taking over Greenland, intervening in Iran, telling the leaders of Cuba and Nicaragua and Colombia to watch their backs, and there could well be developments elsewhere. You could draw one thread through the recent developments, with the exception of Iran. I'll bring the separate thread to tie all that in a second. But in terms of Latin America, one is the so-called Donroe Doctrine, that the U.S. should be surrounded by friendly neighbors, acquiescent to its interest, and it will carry out regime change or do other actions to make sure that it has like-minded neighbors that support its own national interests, and it will not tolerate anything beyond that. Somewhat imperial, but that's the doctrine, if you will. I think it is also playing to the hand of Marco Rubio, the Secretary of State, who has 2028 presidential aspirations, and developments in this part of the world, particularly with respect to Venezuela and Cuba, will certainly give him some talking points to his Hispanic base as he prepares for a run in 2028. But that's one thread. The other thread, in my view, is China, that going after Cuba, Nicaragua, Venezuela, Iran, are all part of a great game to reduce China's influence with regimes that have shifted away from the U.S. in recent decades and years, and to deprive China of access to rare earth in Greenland or oil out of Iran or Venezuela could well be part of a bigger gambit. And it could be different constituencies of Donald Trump are looking at different threads. The likes of Marco Rubio are thinking about the Donroe Doctrine and the Hispanic base. And then those who are thinking about the great game between China and the U.S. are thinking about the threat of tying Iran as well as the likes of Greenland, Venezuela, and Cuba together. So it could well be about China. It could well be about the Donroe Doctrine. It may very well be about all of the above. But the fact of the matter is, a president who came to power saying that he was not in favor of a great deal of engagement outside, his focus was domestic, has really gone off script in that regard, intervening very heavily. But I don't think it's going to necessarily hurt his standing within his base, because these interventions, at least from the perspective of the U.S., are not very costly. It's not entailing a massive amount of boots on the ground. It's not creating any headlines about U.S. casualties, striking Iran from the Persian Gulf with missiles or dropping some special forces in Caracas. They, I think, will go down pretty well with Trump's base. So I don't think necessarily that shifting away from the inward-looking MAGA doctrine is going to be that expensive for Donald Trump. But what about the domestic agenda? Isn't that what it's supposed to be all about? And is it creating a crowding out, if you will, so much attention on external, and therefore Donald Trump will have less time for domestic? Well, I don't think so. Consider the flurry of announcements just in the last couple of weeks, whether it is pressure on the Fed. We saw quite a bit of pressure last year, culminating into investigation against Lisa Cook, Fed governor, as well as significant amount of browbeating against Fed Chair Powell. But then, of course, the new year has begun with indictment against Fed Chair on account of overspending or not properly accounting for the overspending with the renovation of the Federal Reserve building in Washington, D.C. That's been, seismic in terms of people's view on Fed independence and Donald Trump's desire to go after what he considers are people who are not fully aligned with his views. And that's just the tip of the iceberg. In terms of domestic intervention, we are hearing about price control measures, whether it's telling drug companies not to charge more than what is considered reasonable, to interest rate curb proposals on credit card companies, or dividend payment cap on defense companies, or telling private equity companies or institutional investors that they should not be allowed to own residential real estate, or nudging Fannie and Freddie to buy $200 billion of mortgage-backed securities. All of these things also have a thread, which is the affordability issue, cost of living issue. The president wants to come across to a wide range of Americans that he cares about cost of living and is trying to reduce the cost of drugs and credit card debt servicing and housing related expenses and so on. And of course, all of it can also be boiled down to his desire to see lower interest rates. So the bottom line is that domestic agenda has one key lever for 2026, which is the cost of living. You saw the other levers in 2025, immigration-related issues, downsizing the government-related issues, and then channeling some of the tariff revenue into supporting domestic businesses, particularly the farmers, and some of that will also spill over into 2026. But the big push is cost of living, and I think the setback that the Republicans suffered during the off-cycle elections in November of last year have been the fodder for this shift. And given the midterms are coming in about 10 months' time, this will remain a very big source of push from Donald Trump. I personally think that this is coming in a bit too late in the day. I'm not sure whether one can turn cost of affordability issue around so easily. That too, with the helter-skelter, some demand-side measures, some supply-side measures. I don't see major deep thinking around these issues. It's more like performative, some to play to the gallery that I am doing something, as opposed to you will see substantial decline in your cost of living in the near term. And I think that's simply not possible, even if the intention was substantial and non-performative. The fact of the matter is the U.S. has seen significant increase in cost of living in the last 5 years. It is not a U.S.-centric phenomenon. It's happened around the world. Post-pandemic recovery was lopsided, and certain things have become more dear. Immigration measures have not helped that. Tax cuts have not helped that. And those things are not going to be ameliorated under Trump's agenda in 2026 either. But putting aside the domestic and external push that we have seen over the last few weeks, which in my view will remain the case going ahead, action against Iran with respect to Greenland or any other countries in Latin America, very much on the card. This is a very emboldened presidency. But putting all this aside, how is the economy looking overall? Well, Atlanta Fed's nowcasting says that growth is extremely strong, 4 to 5%. At this moment, we think that the 2025 data, when the fourth quarter data comes out, would show U.S. grew by over 2% that year. We are still forecasting a slower economy for 2026, but the very current and present outlook for the first quarter looks pretty rosy. Consumption is very strong. Households are not fazed by the geopolitical uncertainty or the volatility coming out of the White House. Their sentiments are not that great, but their consumption behavior does not necessarily go hand in hand with their poor sentiment. They're still spending a lot, buying a lot. The wages, we'll talk about labor market from a jobs perspective later, but just from a wage perspective, wages are growing in positive terms, in positive real terms, and therefore consumers are okay. They've seen their equity portfolios do very well, to those of them who have stocks. They have seen their debt GDP ratio from a household perspective fairly stable or even declining. Not everybody, but a large part of the population. Because when we look at aggregate debt GDP ratio, it is looking very favorable, notwithstanding some people's issues with respect to medical debt or car debt or student loan issues. Those pain do exist in parts of the economy and parts of the households, but overall aggregate ratios for the household sector looks pretty good, and therefore that is consistent with the strength in consumption that we have seen so far. So consumption-led growth, with, of course, AI investment being a second fiddle to it, is certainly helping the used economy grow at trend or above trend. And that'll, I think, will continue for a while. Now, but juxtaposed with that, strong asset markets, strong GDP growth, strong consumption, is the fact that the labor market has really, really weakened. We now have data for all of 2025, and it's definitely the weakest labor market we have seen in a very long time. In Trump 1.0, during times when Biden was president, COVID pandemic notwithstanding, the monthly gains of jobs in the goods sector, in the services sector, in public sector versus private sector, everything has weakened substantially through the course of 2025. In fact, the goods sector in 2025 had a net reduction in jobs. Same stands for 2025 government sector jobs. So those sectors actually shed jobs last year. I can't see that turning around in 26 either. All that tariff-related work that Donald Trump has done has not revitalized U.S. manufacturing, particularly with respect to manufacturing jobs. We might see industrial output go up, but we're not seeing jobs related to manufacturing go up in any meaningful manner on aggregate to help the economy. So I think the risk for the rest of the year is that the jobless recovery or the jobless growth continues. Growth numbers top line are good, but that does not necessarily impress the base. That does not necessarily impress the middle America or the swing state votes, which will play a big role in the midterm elections in November. So I remain fairly pessimistic about the Republicans' chance of retaining the House in November, even if the economy delivers strong numbers with respect to GDP growth and stock market gains. Now, related to that issue is also what's happening with inflation and what it means for Fed policy. Our official forecast is for just one more rate cut, the terminal rate in the cycle being 3.5. We might have to rethink that in the coming months and quarters. When we look at core inflation, it probably has further room to ease. Not going down to 2% anytime soon, but certainly not hovering around the 3 handle that we saw for most of 2024 and 2025. The tariff-related inflation has been fairly diffuse and protracted. The immigration tightness-related impact on the service sector, again, has not been seismic. There's been some inflation inertia. It'll certainly keep inflation above trend, but it will not take to 3% plus area, which would cause huge problems for the Fed in terms of monetary policy decision making. Now, I don't know who's going to replace Jay Powell, probably Kevin Hassett, but we'll see when the decision comes. But no matter how dovish the next year is, I don't think the path of the Fed will differ that much from what would have been the case even if it was Powell through 2026. If inflation does stabilize around 2.5 or lower, the Fed will cut more, and I personally might have to revise my own forecast. for the time being, it's a wait and see. A couple of months of data does not tell you the whole story. There are many ingredients in place in the economy that could push prices up. So we will wait for a few months and revisit this down the road. But maybe inflation is not going to be the big problem for 2026. I still believe that the AI concentration with respect to the equity markets valuation, with respect to what's happening to the investment dynamic in the economy, even in the tech sector, is a source of worry. That a tremor in that sector would have wide-ranging implications for the entire economy. The U.S. economy's top-line growth seems to be a bet on AI, and even if slightly off course with respect to that, could have seismic impact on consumer sentiment, asset prices, as well as the investment dynamic. So that's the issue related to the near-term cyclical considerations. Now, I do worry a lot about institutional degradation in the U.S. That under Donald Trump, we have seen huge politicization of many parts of the government and a lot of the inconsistent decision-making processes and a lot of deviation from long-standing norms. But I think that the impact of those developments, as worrisome they are for the economy and the nation, they're for the medium term. I don't think they will necessarily manifest in investors dumping US dollar or dumping US treasuries or selling US stocks. I think generally speaking, there's a bit of a tug of war, a lot of worries for the medium term, but for the time being, investors can take those things and take the US economy, which is going through this amazing boom on the back of AI, into their strides. US dollar will probably stay on the back foot on account of weaponization of the currency and the myriad of aggressive geopolitical maneuvers. And that, in turn, is a bit of a source of relief for Asia because they will see stable currencies. They will see room for monetary policy easing if indeed the US dollar is on the back foot and their currencies are stable. But that was the story for 2025. I don't think there's a whole lot to that story in 2026, unless, of course, the White House, the US administration end up doing things that are even more debilitating for the global economy and global market sentiments than it was in 2025. So as you are all familiar with the taco acronym that Trump always chickens out, would he chicken out if there was another market sell-off around tariffs or his actions in the Middle East? We'll see. It seems to me that on the geopolitical side, the president seems to be a little less impervious to what others say because he has had a lot of success in this area from his perspective over the last 12 months. Now, enough about the U.S. I want to talk a little bit about China and where it stands. Now, of course, the story as far as the cyclical headwinds on China remain unchanged. There is a lot of problem with respect to the property sector, which then spills over to the financial sector. Growth in China, just like the U.S., is most likely also fairly jobless, which creates problem for social cohesion, social stability, if indeed there are a lot of young people who just can't get jobs. But the Chinese financial markets have gotten a major tailwind, again, just like the U.S., around AI and other innovation. And that certainly is helping sentiment to some extent. A Chinese population is, of course, even less exposed to the stock market, is substantially less exposed to the stock market than the American counterparts. But nonetheless, good headlines on paper of companies doing well, of entrepreneurs getting wealthy, certainly help the national psyche. And the fact that we're seeing relentless flow of innovation coming out of China, the fact that despite major U.S. efforts, or I would say Western efforts, to degrade China's tech capabilities, China sort of kept up pretty well on the AI space and doing exceedingly well in various other tech areas is a testament to the Chinese economy's ability to be resilient. And I think that again, I think adds to the confidence of the Chinese policymakers, adds to the confidence of Chinese entrepreneurs. And that certainly should help growth in that 4.5% handle for 2026. Now, one thing that we read and hear a lot about is that 2025 was a year when, despite losing access to parts of U.S. markets and facing a huge amount of tariff-related pressure, China continued to expand its exports to the rest of the world, dumping cheap goods, and that's going to be a big issue. I think we need to set the record straight in the area. When we look at China's market share in various key product categories, it doesn't look like they are decimating local industries in Europe or elsewhere, which is a popular narrative, because they're just sort of dumping products that they can't sell to the U.S. That's simply not in the data. What is also missed out on a regular basis is that China came to this big escalation of trade war with a major structural shift in its economy. If you look at some numbers into what is happening in China with respect to green transition, it's just absolutely jaw-dropping. Clean energy contributed nearly $2 trillion to the Chinese economy in 2024, and perhaps a little more in 2025. So we're talking about a tenth of China's GDP is now directly linked to the green economy. 26%, a quarter of China's growth is coming from that area. So China is not dumping products. It has actually found a whole new category of products to export to the rest of the world, from next generation batteries to EVs, to next generation of solar cells, to technologies around wind turbine. That's where China's big gains in market share are. And these areas, China is an undisputed tech leader in the world, including the tech companies that are providing these solutions from the West. So China's EV exports are up something like 75% to ASEAN countries, 10% up for Europe, despite facing tariffs there, and almost tripled in Africa. I don't see that trend dissipating anytime soon. And the thing is that there is some positive spillover out of that. It's not just about Chinese companies taking out other auto companies in the world. These EV supply chains are also elaborate. They don't have all their parts in China. There is not 100% manufacturing in China. As a result, ASEAN countries, South Asian countries, African countries are beginning to see FDI around the EV ecosystem in battery charging, on car assembly parts. And that is also helping the region, particularly Southeast Asia, get another leg up in manufacturing prowess, tech transfer, and improved exports potential. So it is important to take this issue into account, because without sort of taking into account what's happening on the China's green economy, it's very hard to understand the resilience and outperformance of the Chinese economy. I think in the second half of this decade, so 26, 27, 28, and beyond, we will see more innovation coming from China, not just in the green side of the economy, but also in avionics, in drug discovery, and construction material, and so on. That again will persuade many economies in the world, perhaps even the Western economies, that they want some of this technology, they want some of these products. So I remain fairly constructive about China's export potential, and I largely reject the dumping argument, which I've been hearing a lot in the media and among even analysts. So now the issue related to AI extends both in China and the US, but of course, China doesn't have the cutting edge tools that the American counterparts do. And despite that, some of the models that Chinese AI companies are coming out with are outperforming many of their US counterpart AI models. And we saw the DeepSeek moment last year. I would not rule out similar moments coming out in 2026 either. And the key metric for that prediction is how closely American tech companies are watching Chinese tech companies and following their progress and their releases of various Gen AI models. So they genuinely take it very, very seriously. So the AI boom can sustain further investment growth both in China and the US in 2026 and beyond. But then again, as I said earlier, it does create some degree of worries that what would happen if the revenue side of the AI did not come out as persuasively as all these massive investments would require them to do. All right, so that's the key sort of sense of where I stand with respect to the U.S. and China, and China's resilience, U.S.'s outperformance, and also the spillover positive impact on ASEAN. Americans continue to spend a lot. That helps ASEAN exports. China is expanding its footprint with green energy-related footprint, as well as some degree of trade diversion. Let's not sugarcoat that. And ASEAN, again, benefits from that substantially. I want to move away from China, US, ASEAN to one particular aspect of ASEAN, which is the country that I live in, Singapore, and where Singapore stands. I think Singapore has many vulnerabilities. It's a very small, open economy. It absorbs, or is bound to absorb, global shocks readily, but it has shown tremendous degree of resilience, and it thrives through the uncertainties of 2025 and done very well. I don't think a high 4% growth, which is the likely outcome of 2025, is repeatable in 26, but Hang Chua, our Singapore senior economist, and I both feel that another year of trend growth is very much on the cards for Singapore, notwithstanding all the different things that we can focus on in terms of negative drivers. Those are obvious in my view, from trade and tariff-related additional uncertainty to geoeconomic risks. So let's put that aside. We recognize all that, but rather focus on what are the possible upside levers for Singapore in 2026 and perhaps even beyond. Well, firstly, the issue related to the monetary conditions. I think that rates, the way they have come down in Singapore over the couple of last year or so, that has led to financial conditions becoming significantly more accommodative. That will sustain. Inflation-related concerns are few. Liquidity is ample. It's fueled by strong capital flows. And these factors ought to lead to lending and borrowing risks leave them in check. And this would, again, support capital market activities. And I want to focus on one specific aspect of Singapore's capital market that's been long dormant, but is likely to go through a major uplift in 2026. And that is the second positive lever, which is the trading activity around Singapore's equity markets. On the back of several measures that already began to energize Singapore's equity markets in 2025, I think there's further impetus for that. We saw some late year announcements, which will help the equity market in 2026, dual listing bridge between SGX and NASDAQ, appointment of the second batch of asset managers under the $5 billion equity market development program, and several structural measures to enhance market trading and structure of the way Singapore stock market works. So I think that I understand that there's a pretty impressive line of IPOs as well. So as long as overall global investor sentiments remains stable, I think there'll be significant capital raising and significant market making done in Singapore's equity sector this year. And that, of course, will help sentiment and growth. Third is the most obvious one, AI-related investment and policy measures. So Singapore's public and private sector both are ramping up AI-related spending. Efforts to upskill the workforce are progressing. AI adoption is being hastened by the data and tech infrastructure buildup. There is strong expectation that tech services will become more seamless in the coming years as AI integration materializes. And again, this is both with respect to government service delivery as well as the various solutions that the private sector is coming up with. Fourth area of upside would be continued interest in Singapore's trusted business hub. Recent years have seen record private banking and FDI flows to Singapore, a testament to its reputation of stability. And we're sure that trend will persist this year and beyond. Then there are regional initiatives. Let's just focus on one, which is the Johor Singapore Special Economic Zone. We're expecting further progress there. Billions of dollars are being invested by Singaporean firms to take advantage of the synergy between the two areas. They encompass a wide range of areas: land, talent, tech, tourism, housing, trade, and then there's a massive construction boom evident to anybody who passes through the causeways this year. Once the rapid transport system link, the RTS, gets going at some point this year, it'll only go strength to strength in terms of the symbiosis between Singapore and Johor. So watch this space, lots coming here. And then finally, not related to the regional initiatives, but for domestic initiatives, construction sector in Singapore. Multi-year boom is underway. This year might be the best year in a long, long time. Building activity, mega projects, Changi Airport Terminal 5, Tuas Port, North-South Corridor, Marina Bay Sands, Resorts World Sentosa, substantial housing rollout, both public and private. All sorts of things are going on the construction side. Expect to see substantial contribution of that sector into Singapore's GDP growth in 2026. So 1.5 to 2% growth, very likely. If things just stay stable, could be even more than that on the back of these 6 levers that I'm talking about. So I think the key takeaway for our listeners for today who have been patient enough to listen to me so far should be that while there are many concerns about the outlook, given the external worries driven by a highly assertive and deeply hegemonic US, we are focusing on positives, just like we did in 2025 and came out ahead of the game despite the myriad negative shocks that were there. So I think that 2026 could very well be another year. We should recognize that there are many concrete levers of support in place. The outlook is not entirely comprised of negatives, number of positive out there as well. So net, hopefully we come out ahead in 2026, just like we did in 2025. So that's it for today. Thank you very much for your time, our listeners and viewers. Kopi Time was produced by Ken Delbridge, Spy Studios. Balash Lee and Daisy Sharma provided additional assistance. All 169 episodes of this podcast are available on YouTube and on all major podcast platforms, including Apple, Google, and Spotify. Mind you, this is a podcast for information only. It does not represent any trade recommendations. As for our research publications, webinars, and live streams, you can find them all by Googling DBS Research Library. Have a great day.